Hi, welcome to TABB Forum. I'm here with Phil Wang, Senior Vice President of Capital Market Services at OpenLink, and we're here to talk about the SEF markets, SEF market implementation and execution. So here we are coming up to the final implementation of mandatory trading on SEFs, and the world is about to reveal itself after a lot of focus and attention. So are the buy side ready for SEF implementation, do you think, Phil?
Right. Well, are they ready? I think in a lot of ways they are ready. I mean, all of them have, gone through, picked their SEFs for rates, picked their SEFs for credit. I think they have a good understanding of how it's going to impact their different front, middle, back office, and the obligations of such. I think where they're less ready is they haven't necessarily made the technology investment to, say, fully optimize an STP workflow for a SEF executed trade in their different systems.
And is there any variation between the onboarding process among the different SEFs that they've chosen? Do you think they're more advanced with some and then less advanced with others, or is it basically a similar process for each?
Right. Well, I mean, I think, when you talk to our clients, they traditionally pick, say, maybe 4 or 5 SEFs that they're going to use. And they've probably identified 1 or 2 that, okay, let's go ahead and make a leap and maybe make more of an investment from a technology perspective to connect to them. But I wouldn't necessarily say they've made that investment across the board to all SEFs. And, I think there's a lot of things that they're waiting for to evolve in the market to decide whether to make that technology investment.
Okay, so what do you think the key differentiating feature is going to be between the different SEFs? Looking at the market overall now, not just the different ones that the buy side have chosen.
Sure. Obviously, I think the big question that everyone's asking is, where's the liquidity going to be? Or is there going to be some consolidation in the SEF market over time? No one wants to make the investment to build connectivity and structure workflows with the different SEFs, only to see that SEF not have any liquidity or possibly consolidate in a year or so time. And I think another interesting aspect is, again, I think people are starting to question, do they really want to be a member of a SEF? And how are some of these alternative ways of execution that are evolving, such as sponsored access, agency models, introducing brokers, how is that going to play out? And maybe down the road that might be a better solution for them, and that entails a different investment and a different twist on how they might want to integrate that into their platforms.
Great. So liquidity is going to be very important, and then the whole process of how you onboard with people is going to be very important. So looking at the workflow and how that's changed since we started this whole process, how is that going to be different from the traditional paradigm and methods of execution that we used to see?
Sure. I mean, I think, the SEFs now introduce a lot of challenges because, yes, electronic trading, transparency sounds very nice, but now there's a lot of choices that need to be made. Choices on the SEF of what's going to be MAT, what's a permitted trade, what can I do via voice. Do I want to handle unsolicited versus solicited workflows? How do I aggregate liquidity, aggregate pricing across the different SEFs? So there's a lot of workflow challenges in terms of making that determination, and in terms of just the whole STP life cycle. Where do I do my pre-trade compliance? How do I then send that order up to a SEF and get fill details, allocation details, other details back from the SEF? How do I then reconcile the trade with the SEF on some other service provider? How do I monitor what has potentially could fail clearing with the clearinghouse versus things that have been accepted for clearing? There's a lot of challenges that a SEF executed trade introduces that they weren't traditionally used to. And that's on top of the additional record keeping and audit trail and additional data that they have to maintain if they are a member of a SEF now.
Absolutely, not to mention breakages and things like that, dealing with all of that. Will the agency side of things be able to help out with some of that, do you think? Or is it something that people individually are going to have to get comfortable with on their own?
I think absolutely. I mean, obviously the appeal of the agency model is taking a lot of onus off of the participant themselves to do a lot of that record keeping, to do that audit, and to build that connectivity to all the different SEFs. And if that agency model can also provide other services like SEF aggregation, again, it's one less worry that that firm needs to worry about. So I think that just goes back to the point of people are taking a wait and see. Yes, I have to execute on SEFs for now, these mat trades, but down the road, maybe there's these other alternatives that I'm going to steer myself towards. So the question is, do you make the technology investment now or do you wait?
Great. So overall, what kind of time frame do you think that's all going to take before the dust settles, people come to their decisions and think strategically, this is where I want to be now?
But I mean, I would see a lot of clarity coming up, you know, in the say next 1 to 2 years, there should be a lot of clarity in terms of where people see themselves moving. I think it's going to be very interesting in the next 6 to 9 months to see where the liquidity does go and what happens with it. But I think we'll get a lot more clarity when we're sitting here a year from now.
Great. Well, thanks very much for coming in to join us, Phil. This is Radi Khasawneh, Fixed Income Analyst at TABB Group.